Hello guys, welcome to a new video. In this video I'm going to be explaining market structure. Market structure is the foundation of learning how to trade. If you don't understand market structure, you are not going to be a successful trader. As a beginner, you need to focus on how to identify trends, bullish and bearish trends, consolidating trends. So before we get into the video, if you have not subscribed, please subscribe and leave a like and leave a comment if you learned anything from the video. So I see a lot of traders struggling with market structure. Market structure is the foundation of trading. Without market structure, you are going to be having a lot of losses in the market. So in this video, I'm going to break down market structure in a very simple format. So the foreign exchange market moves in three ways. We have the bullish market, we have the bearish market, and then we have the consolidating market. Let's start with the bullish market. When we say the market is bullish, we are referring to, in simple terms, we are referring to a series of higher highs and higher lows. Oh, that's too complicated. When we say the market is bullish, in simple terms, it just means the market is going up. In the foreign exchange market or in any market, crypto, stocks, whatever, the market doesn't just go up like this. Like, it doesn't just boom in a straight line. Nah. Or the market will just go up like this. Nah. It doesn't happen like that. The market is going to go up in the form of series. The market is going to go up in the form of series. And these series are called higher highs and higher lows in a bullish market. In a bullish market, let me say this again, guys, so you can understand. A bullish market is when the market is going up, in simple terms, and the market just doesn't go up. It creates a series of higher highs and higher lows. So how you can identify if the market is bullish is by identifying what the series of higher highs and higher lows. It's as simple as that, guys. And how do you identify the series of higher highs and higher lows? It's simple, by using your highlighter tool. Let's say we're trying to identify this market now, this one that I just illustrated here now. Higher high, let me just quickly write this down here. Let me just quickly name it. Is it higher low? Higher high. Higher low. Oh shit. I missed this one. It's a higher low. This is a higher high. This is a higher low. This is a higher high. This is a higher high. This is a higher low. This is a higher high. Sorry guys, 1 second please. Let me just quickly respond to my mom. She's just quickly texting me. Yes, so guys, in a bullish market, we can identify in a bullish market is when the market is going up, when the market is in an uptrend. So in a bullish market, we can identify a bullish market by a series of higher highs and higher low. This occurs when each new high is higher than the previous high. So here we can see that this is a higher low and this is a higher high. Why? Because this high is higher than the previous high. Simple as that. This is a higher low, this is a higher high. Why? Because this high is higher than this high. Simple. This is a higher low, higher high. Why? Because this high is higher than the previous high. This is a what? Higher low, higher high. Why? Because this high is higher than the previous high. This is a what? Higher low, higher high. Why? Because this high is higher than the previous high. And same sequence if you're following the lows. This is a higher low. Why? Because this low is higher than this low. This is a higher low. Why? Because this low is higher than this low. This is a higher low because this low is higher than this low. This is a higher low. Why? Because this low is higher than this low. It's as simple as that, guys. Higher high is basically means when price is breaking above the previous structure. When price breaks above the previous structure, it's called a break of structure. Whenever the previous high is taken and a new higher high is created, this is called a break of structure, guys. As simple as that. It's showing that buyers are pushing price to break new peaks. Basically, as simple as that. The buyers are in control and buyers are pushing price to break new peaks. That's it. And for the higher lows, it means that sellers are unable to push price as low as before, meaning buyers are stepping in earlier. So let me illustrate this break of structure for you guys so you guys will understand very well. So anytime a new higher high is created, a new higher high is created when price breaks the previous high. And whenever price breaks the previous high, it's called a break of structure. You mark it out. It is called a break of structure. You mark it out again. A break of structure. I think I should just write it down to be easier for you guys. It's called a break of structure. It's called a break of structure. This is called a break of structure. This is called a break of structure. So this is for a bullish market. As simple as that. A bullish market is when the market is going up, meaning when the market is in an uptrend. You identify a bullish market by the series of higher lows and the higher highs. A simple way to understand it is each time price is going to break the previous high to create a new higher high. And whenever price breaks the previous high, it is called a break of structure. It's as simple as that, guys. And this is for the bullish market. So let me illustrate for the bearish market. This is a bullish scenario. And then for the bearish market, this is when the market is going down. This is when the market is going down, which simply means that sellers are in control. It's as simple as that, guys. Bullish and bearish. The bulls are pushing the price up and the bears are pushing the price down, which means sellers are in control. And how do you identify a bearish market? You identify a bearish market by a series of lower highs and lower lows. Series of lower highs and lower lows. A bullish market you identify by what? By a series of higher highs and higher lows. It's as simple as that, guys. A bullish market you identify is from the series of higher highs and higher lows, and a bearish market you identify by the series of lower highs and lower lows, which simply means when the market is going down, the market is in a downtrend. It's literally the exact opposite of higher highs and higher lows, the patterns, the sequence. A bearish market means sellers are in control and price is constantly moving downwards, and every attempt by buyers to push it up fails earlier than before. So let me just quickly illustrate this. My path tool here. Series of lower highs and lower lows. Ignore my drawing, guys. So in this bearish market, we're focusing on the series of lower highs and lower lows, the exact opposite of higher highs and higher lows. So here, just for illustration purposes, I'm going to be using this text. So this is a lower high and this is a what? This is a lower low. As simple as that, guys. When the market breaks below the previous low, it is called a lower low. When the market breaks below the previous low, it is called a lower low. And this is called a what? A lower high, because this high is lower than this high here, the first high. This is called a lower high because this high is lower than the first high. And what's this gonna be called? This is going to be called a lower low. Let's go again. A lower high because this high is lower than the previous high, and this is called a lower low. Let's go again. A lower high and a what? And a lower low. Why? Because this high is lower than the previous high and this low is lower than the previous low. Let's go again. A lower high and a what? And a lower low. As simple as that. A lower high and a lower low. As simple as that, guys. The market is forming lower highs and lower lows, which indicates that sellers are in control. This means the market is bearish. That means we're in a bearish trend. The market is going down in simple terms. This means sellers are pushing the price down. Sellers are driving the market down and buyers can push the price back up. This is showing that the currency is continuously losing value or continuously weakening. So this is the downtrend and this is the uptrend. So in simple terms, guys, bearish market is identified by the series of lower highs and the lower lows. Bearish market is when price is continuously breaking structure to the downside, meaning it's creating a sequence of lower highs and lower lows. Simple, which means sellers are in control. It's as simple as that, guys. And whenever price breaks below the previous low, it's called a break of structure. Mark it out. Break of structure. This low, this high to this low, price took this previous low, and this is called a break of structure. From this high is lower than this high, and this low is lower than this low, and price broke below the previous low, which is called a break of structure. Guys, as easy as that, guys. Market structure is not complicated. It is literally the foundation of trading. Without market structure, you are going to be trading blindly because you are not going to be able to understand the trend of the market. And if you can't understand the trend of the market, how do you want to be able to place a trade? That means you're just gambling or you're just guessing. So, and by the way, if you want to work with me one-on-one, I'm going to leave my Calendly link in the description. You can book a call with me and we can work on the one-to-one. I'll teach you everything you need to know about the foreign exchange market to become a profitable trader. So let's move to the consolidating market. Let's move to the consolidating market. Consolidating market is when the market is neither bullish nor bearish, which means the market is neither going up or going down. So this happens when the market is in between the bullish and the bearish trend. This means the market is ranging. The market is moving sideways. The market is neither forming a series of higher highs nor a series of lower lows. Meaning the market is neither bullish or bearish. Instead, price stays in a specific zone. It's just going up and down, up and down. It's like it's stuck in a box, basically. So basically, it means when sellers and buyers are balanced, there are no clear buyers and there are no clear sellers. So it's like market is in an equilibrium. So let me just write it down. This means when the market is neither bullish nor bearish. It's as simple as that. Don't overcomplicate it. And a consolidating market, this is an illustration of a consolidating market. This is literally an example of a consolidating market. This is when the market is neither going up nor going down. So the market, you can see that there is no higher highs or higher lows. Literally, all this they're equal. All these lows are equal. All the highs and lows are equal. There's no higher high nor higher low. It's as simple as that, guys. And you should avoid trading in a consolidating market. It's as simple as that. You should avoid trading in a consolidating market because there is indecision. Market participants are uncertain about the price direction. The markets may be accumulating liquidity for the big move. That's what happens. Or price consolidates when there is no liquidity. Like usually when we see consolidation in the foreign exchange market is when there are public holidays because the big banks, the smart money, they are not usually trading. So the market is usually very, very choppy, meaning no clear direction. The market is neither going up nor going down. So, in summary, the bullish market is when the market is going up, which means buyers are in control, and you can identify it by the series of higher highs and higher lows. And the bearish market is when the market is going down, which means the market is in a downtrend, and you can identify it by the series of lower highs and lower lows. As simple as that. So let me teach you guys how to identify this on the chart. So before then, guys, I want to show you guys how you'll be able to identify this on the chart after this illustration. I'm going to use a bullish scenario and I'm going to use a bearish scenario in this example I'm about to give. In this bullish scenario, as a beginner, you want to get familiar with using your highlighter tool. You just come here on your left, click on your highlighter tool and click on it. So with your highlighter tool, you want to be able to mark out the series of higher highs and higher lows. Until you become a pro, you need to be able to use your highlighter tool freely. So this is how you use your highlighter tool in the real market. Let's say now the market is bullish. I know the market is bullish. Let's say I come into the market, I'm trying to identify the trend. So I go on here, click on my highlighter tool here, and I see, okay, this market is going up. How do I identify it? By the series of higher highs and higher lows. I'll mark out this is a higher low, this is a higher high. Why? Because price broke below this previous high, and which is called a break of structure. This is a higher low, this is a higher high. Why? Because price broke above this previous high, which is called a break of structure. This is a higher low, this is a higher high. Why? Because price broke above this previous high, which is called a break of structure. This is a lower high, this is a higher low, sorry, and a higher high. Why? Because price broke above this previous high. This is a higher low and a higher high. Why? Because price broke above this previous high. This is in a bullish market. So let me show you guys some chart examples. You can see that this is a higher low, this is a higher high. Why? Because price broke above this high. This is a higher low, this is a higher high. Why? Because price broke above this high. It's as simple as that. This is how you identify who is in control. Again, we go. This is a higher low, this is a higher high. Why? Because price broke above this high, which is called a break of structure. So we have, in the next video, I'm going to be explaining external structure and internal structure and complex pullback. So in a bearish market, yeah, you just do the opposite. When price is creating a series of lower highs and lower lows, you use your highlighter tool again. Same thing again, guys. This is a what? Lower high, lower low. Why? Because price broke below this previous low, which is called a break of structure. Lower high, lower low, lower high, lower low, lower high, lower low. It's as simple as that, guys. So let me come here and show you guys some chart examples. Let me just quickly clear all those drawings out. So here we can see that price broke below this previous high. This is a lower high, this is a lower low. This is a what? Lower high, this is a lower low. Okay, this is a lower high, this is a lower low, because price broke below this previous low. Why? Because price broke below this previous low. This is a lower high, this is a lower low. Why? Because price broke below this previous low. This is a lower high, this is a lower low. Why? Because price broke below this previous low. It's as simple as that, guys. So if you're having problems with market structure, I believe this video is going to clarify a lot of your mistakes that you have been making on the chart when it comes to marking up the series of lower highs and lower lows. Let me look for a consolidating market for you guys. What's like a 5 minute? Trying to find an example of consolidation market, but I can't find it. But a consolidation market is basically when the market is not trending bullish, not trending bearish, meaning the market is neither creating the series of higher highs nor creating the series of lower lows. As simple as that, guys. So leave a thumbs up and subscribe if you really enjoyed this video and if you found it helpful. Link to join my free Telegram is in the description, and if you want to work with me one-on-one, book a call and then we'll get into business. Thank you. See you guys in the next video.